From violations to prevention, why accounting is the backbone of compliance. In the last section, we walked through real-world violations and audits, the moments where brokers get into trouble. Now we shift gears into the solution side of that equation, accounting systems and terminology. Because here's the truth in property management. Most violations we discussed don't start with bad intentions. They start with poor accounting practices. If your numbers are wrong, your documentation is weak, or your systems are inconsistent, it is only a matter of time before it shows up in an audit. This is where strong accounting knowledge becomes your best defense. Accounting is not just about numbers, it is about control, transparency, and protecting client funds, which ties directly into your fiduciary duty as a broker. Trust accounts, the center of everything. At the heart of property management accounting is the trust account. This is a separate bank account used to hold funds belonging to others, such as tenant rent, security deposits, and owner reserves. This connects directly to what we covered in the audit section. If trust accounts are not handled properly, that is where violations begin. For example, if a broker in Mesa deposits rent into their business operating account instead of a trust account, that is called commingling, and it is one of the fastest ways to face disciplinary action. The rule is simple: your money and your client's money must never mix. Escrow and the flow of funds. Another key concept is escrow, which refers to funds being held by a third party until certain conditions are met. In property management, this concept shows up in how funds are held, managed, and eventually dispersed. For example, a security deposit is essentially held in escrow until the tenant moves out and the final accounting is completed. Understanding how money flows through your system is critical to staying compliant. Account reconciliation, where problems are found or prevented. One of the most important processes in property management accounting is reconciliation. This is where you compare your internal records with bank statements to ensure everything matches. This ties directly back to the audit process we discussed in the last section. For example, if your bank account shows $100,000, but your internal ledgers only account for $97,000, you have a $3,000 problem, and auditors will find it. Reconciliation is not optional, it is how you catch mistakes before they become violations. Ledgers, tracking. Every dollar. The general ledger is your master record of all financial activity, while tenant ledgers track activity for each individual tenant. Think of it like this: the general ledger tells the story of the entire business, while tenant ledgers tell the story of each individual relationship. For example, if a tenant in Gilbert disputes a late fee, the tenant ledger should clearly show rent payments, fees, and balances. If it's not in the ledger, it becomes very difficult to defend your position. Receipts and disbursements, documenting the movement of money. Every dollar that comes in must be documented with a receipt, and every dollar that goes out must be documented as a disbursement. This creates the audit trail we discussed previously. For example, rent collected from a tenant in Chandler must be receipted, deposited into the trust account, and then dispersed appropriately to the owner or vendors. Missing documentation creates gaps, and gaps create violations. Security deposits. High risk, high scrutiny. Security deposits are one of the most heavily regulated and audited areas in property management. These funds must be properly held, tracked, and returned according to the law and lease agreement. For example, if a deposit is misapplied or not properly accounted for, this can lead to disputes, penalties, and potential legal action. This ties directly back to the violations we discussed in Section 9. Operating account versus trust account. Know the difference. Your operating account is used for running your business, payroll, marketing, and expenses. Your trust account is for client funds only. Confusing the two is one of the biggest mistakes new property managers make. For example, paying office expenses from a trust account is just as problematic as depositing client funds into an operating account. Separation is key. Financial reports. Communicating with the owner property managers are responsible for providing financial statements and monthly reports to property owners. These reports summarize income, expenses, and account balances. For example, an owner in Scottsdale expects to see rental income, maintenance costs, and net proceeds clearly outlined. This is not just good service, it is part of your fiduciary responsibility. Audit trail, your protection in real time. An audit trail is a complete record of all financial transactions, allowing every dollar to be traced from start to finish. This directly connects back to the audit process from the previous section. If an auditor cannot follow the trail of money, it becomes a compliance issue. Strong audit trails protect brokers during audits and disputes. GAAP, the standard for professional accounting. Generally accepted accounting principles, GAAP, provide the framework for consistent, accurate, and transparent financial reporting. These principles ensure that financial information is reliable, comparable, and useful for decision-making. For example, applying GAAP standards ensures that revenue, expenses, and liabilities are reported correctly across all properties being managed. In property management, following GAAP is not just best practice, it is part of maintaining professional and compliant operations. How property managers get into trouble with accounting. Now let's bring this full circle back to Section 9. Most accounting violations come from a few key issues: commingling funds, failing to reconcile accounts, poor record keeping, unauthorized transactions, and lack of oversight. For example, if a property manager fails to reconcile accounts monthly, discrepancies can go unnoticed for months until an audit exposes them. Or worse, improper withdrawals from a trust account can lead to serious legal consequences, including license suspension. Accounting is not just about accuracy, it is about compliance and protection. How this section connects forward. This section completes the loop from violations to prevention. In Section 9, we saw where brokers get into trouble. In this section, we learned how to prevent it through strong accounting systems and understanding key financial concepts. As we move into the final wrap-up of this course, everything comes together into one central responsibility: broker supervision, systems, and accountability. Because at the end of the day, it is not the property manager, the assistant, or the bookkeeper who is responsible. It is the broker. Online discussion. Why are trust accounts critical in property management? Answer: because they protect client funds and ensure that money is handled separately, transparently, and in compliance with the law. How does account reconciliation help prevent violations? Answer: it identifies discrepancies between records and bank statements early, allowing issues to be corrected before they become violations. What is the biggest risk of commingling funds? Answer: it violates fiduciary duty and can lead to serious disciplinary action, including license suspension or revocation.